Welcome back. Now, unlike other property players, Schroder Real Estate has managed to shrug off the impact of high interest rates during the half-year period. It reported a 3% rise in underlying EPRA earnings, boosted by retail growth. And joining me for further insight on the performance is fund manager at Schroder Real Estate, Jeff O'Dwyer. Thank you so much for your time, Jeff. Let's actually start off with how you would characterize the interim period that was.
Yeah, I think it's a really good set of results, and thanks for having me on. But yeah, I think the portfolio is holding up really well. We decided to go very conservative with the company and retain capital and have a really low level of debt from a balance sheet point of view. So that sets us up really good relative to our peers, and we're now in a position to look at investing in the portfolio, potentially looking at recycling some capital. We may do a bit of a sale of one of the assets. We may look at a small share buyback given the discount that we're trading off. So there's some really good opportunities now to grow earnings, and I'm really excited about moving the company forward.
Yeah. Would you say that the fundamentals have successfully and completely diluted the impact of the high interest rate environment, or are there still maybe some pockets of pressure there that you are seeing in your portfolio?
No, well, we actually deliberately retained capital for that risk, and we've actually de-risked that over the last probably 18 months. We've refinanced sort of 5 loans to date. We've been working with banks and successfully achieving margins that have either been in line with what we had before or slight increases. A good example is the recent REN re-gear that we did, where the margin on that increased from 1.4 to 1.6. We secured that on a new 5-year loan. We locked in at the 5-year swap as well. What we're seeing is that banks want to work with counterparties like us, particularly those that can de-risk the sustainability side and have a solution mindset that can work with occupiers. And that's why we're being able to secure the debt that we have. So unlike other investment trusts, we've been able to refinance. We've marked our debt to market, and it hasn't impacted our ability to deliver on the dividend. Our dividend covers 109%, so we've been giving investors further protection there as well.
Yeah. You talk about being conservative, being prudent, even though, of course, you do have a strong balance sheet over there. In terms of your capital spend, where would you be focusing your capital expenditure at this point in this kind of prudent approach?
So we think there's a real opportunity to look at investing in the existing portfolio to try and improve the quality. And therefore some of the sustainability angles. So what we did recently is actually go through sustainability audits and net zero carbon pathway modelling, and that's given us some initiatives as to how we can improve the quality, working with occupiers, maybe potentially looking at sort of moving earnings and rents on the back of those investments. So at the moment we're ranking and prioritising where we get the best bang for our buck. So that's probably the number one focus. We may look at a bit of a share buyback that I touched on before.
Yeah. And
if the discount closes, we may look at another acquisition. But I think at the moment, just given the way the shares are priced, it makes more sense to do that sort of small buyback and also invest in the portfolio to grow earnings that way.
We'll talk about this capital recycling. You spoke about how there could be maybe a sale here, an acquisition there if the discount closes. What will inform your decisions in terms of your disposals and also potential acquisitions?
Well, we've got an asset at the moment that we've just basically re-geared all the leases. It's a small grocery asset that we have in Frankfurt. There's not a lot more that we can do from an asset management point of view. What we're seeing on the investment side is very strong demand for that type of product. So we think that actually if we can deliver value or even value in a little bit, that makes far more sense to sell that and then look at recycling that capital. And that capital could be used to do the share buyback that I touched on, or it could be used to do another acquisition at a slightly higher yield. So that's how we're looking at recycling capital, particularly assets where we can't really actively manage anymore. I mean, it's been a good income generator, but we think we could use the capital through a sale in a much better way. So that's how we're thinking about sort of recycling capital at the moment. And again, ways to invest in the portfolio to improve the quality. And that sort of puts us in a stronger stead from a liquidity point of view to occupiers, to lenders, and also to investors as well.
Jeff, are there any concerns or any focus points that you're looking at right now in terms of the, filtering through of macroeconomic headwinds into your portfolio? I do understand, obviously, you've managed to really navigate the environment quite well, but also you do have interest rate cuts also coming in a very, very slow manner at this point. Some concerns about global growth. Do you have any focus areas there, things that you are closely looking at that could maybe lessen the momentum that we are seeing in your numbers from here on out?
Positively, obviously the ECB decided to reduce rates by 25 basis points on the 6th of June. So I think that's been a welcome addition. That's still probably yet to filter into values and investor sentiment, but we think another rate cut may just focus investors' mindset again. So what we're coming out and saying now is actually we think we've probably found a bit of a floor for values for the industrial side, select retail. There's probably a little bit more downside on the offices. So I think those interest rate cuts will be helpful for the investment side and seeing volumes come through. Obviously, some of the political risk in terms of, particularly in France, that's had a bit of an impact in terms of the risk-free rate. And we've seen the French 10-year bond increase by about 20 basis points. So possibly for France, that may have a bit of an impact in terms of where pricing is. But overall, we tend to look through political risk. And if we get the real estate risk right and we can manage that with our teams on the ground, that puts us in a really strong position to deliver returns for shareholders.
All right. Well, thank you so much for your time and for your insights and detailing those numbers for us, Jeff. That was Jeff O'Dwyer from Schroder Real Estate.